Welcome to our East Bay Post Shelter in Place. My name is Lisa Doyle, and I've been in the real estate business here for about 34 years, so a long time. And we've had over the years a lot of different marketplaces where people have concern and question. And over the last 2 months, it's been a definite adjustment for everyone. And we've had so many people with concerns and questions. We wanted to bring to you guys some answers. So welcome to our webinar. We sure hope that this information helps you. So what we want to do is I want to introduce the participants today as far as our guest speakers. So go ahead if you can, Francesca, put that next slide up. So we have today a wonderful guest speaker, and I'm going to give an introduction of Carl in just a minute. To give an economic forecast today, Carl Rizzuto is joining us. He's a real estate expert, and we're excited to have him aboard. As far as our loan information, Daryl Nelson, and we've worked with him for many years. He's our favorite mortgage lender. He's going to talk interest rates and market and answer some of your loan questions. And then as far as our team is concerned, what we did was we took the top questions and concerns that consumers ask us all the time, and we wanted to answer them for you. So our teammate, TJ Smith, he's a real estate agent, very knowledgeable, has lived in this area most of his life. He's going to speak on first-time buyer concerns and questions. Diana Carcamo is our partner as well, real estate partner, and she's going to speak on, what do you do to prepare your home for top dollar? That's one of the questions people ask us, pretty much daily, is how can I improve my home so that I gain the best return on my money spent and I don't overspend? And then as far as technology is concerned, this has evolved in the last few months. We've seen such a big change in the technology, and we're excited to present what we're doing to help people. So Felicia Lopez, she's an expert on the technology parts of the business, and she's a real estate agent on the team as well. And then last but not least, Kim Winters is, been in the real estate business for 20 years. And so many people have a hard time with the moving from one house to another. So she's going to be speaking on surviving the buying and selling process and how do you move from one house to the other. So we're excited that you're all here. So what I'd love to do is I want to introduce our first expert speaker. So Carl, thank you so much for joining us.
Absolutely.
Yeah, we're so excited to have you aboard. So I want to tell a little bit about Carl's background. So he's been in the real estate business since 1979. And Carl, I know you shared this story with me before, is while you were in college, you started your real estate practice back in the day when you were only 20 years old. Interest rates were 18% or higher, tough time back in 79 to 81 or 2. And yet you were able to help 64 families to buy and sell your first year as a young man, only 20 years old, which is just such a big accomplishment. And since that time, Carl has owned and operated a multi-branch group of offices in the Northeast of our country, where you sold that about 25 years ago. And since then, he relocated to Florida, where he had worked as a real estate broker and built a very successful real estate practice. And I think you sold that about 2.5 years ago. You mentioned Carl.
Yes.
Yep. And then in approximately 2003, Carl joined a company called the Tom Ferry Organization as an expert coach, and he coaches real estate agents and companies all over the world. And what I love is Carl's mastery of the process of coaching and training. He's just a wonderful resource for all of us. So Carl studies real estate every day. And, he's looked at as one of the experts nationwide in our industry. And we're so very fortunate to have you here to help, share your expertise and your perspective. So thank you so much, Carl, for joining us.
Oh, thank you. I'm happy to be with you.
Yeah, so thank you so much.
And I guess I should start.
Yeah, let's do it.
Okay, perfect. Well, again, good afternoon, everyone. I'm extremely pleased to be here with you all. And I hope to provide you with some information which you find helpful and also informative. Being a realtor in excess of 40 years and working through the challenges of 1988, September 11th, the Great Recession of 2008, and even looking back to when I first started in real estate in 1979, as Lisa said, when interest rates were 18% or higher, I believe that what we're facing today is totally different from all of the downturns and issues that our country faced in the past. So as a realtor, I listen to and read a lot of forecasts from many brilliant individuals. And I have to say, Stephen Harney of Keeping Current Matters puts best his analysis, breakthroughs, and he breaks things down and makes it very simple to understand. So I want to start off by sharing one of the things he has said. So what he said is this: when people generally think of a real estate downturn or an economic downturn, right now, meaning over the last several years, when they think about downturns, they often think about 2008. 2008 was one of the biggest recessions our country faced, if you exclude the Depression and certain things like that. So in 2008, Steve Harney puts it this way: it was like a tornado ruining everything in its way: buildings, banks, financial markets. And then once it passed, it took years and years to rebuild. The rebuilding included the buildings, the real estate market, the financial institutions, almost every US industry, and also we had to rebuild our consumer confidence. Investors lost 50% of their portfolio over a couple of years. And it took multiple years to get back to where they were. That was the 2008 market crash. So again, as consumers, we look at the last financial disaster, 2008, and relate that issue as it pertains to the housing market and everything else. But the fact of the matter is, that was a financial issue. And the financial issues are what caused the crash of the market and the economy. That was financial. What we're facing now is an event, almost like a snowstorm. It's not something caused by the financial markets. Yet even when saying that, if you go back into time, you will see that in the last 5 economic recessions, housing was only hit twice, and mainly in 2008. Yet that's what people always refer to when they think about a housing or an economic decline. And we have a slide for that.
Yep, exactly. And the fact, Carl, if the fact that you talk about 2008 was like a tornado hurricane, destroying everything in its wake, and today is more like a snowstorm where the snow is going to melt off, and it's like we're not likely to see the same type of issue. So I love that.
That's correct, and I'm going to go into that a little bit more. Yep. We have another slide, though. It was called home price changes. Okay, so if we look at that slide, it outlines the last 5 recessions. And what you'll see in 1979, 1980, there was a recession, yet the housing went up 6.1%. 1981, it went up 3.5%. 1991, it did go down, yet it only went down 1.9%. In 2001, when there was a recession, housing went up 6.6%. The major issue or challenge was the 2008 recession, when housing went down about 20%. But in the last 5 recessions, there was really only one which was substantial in a negative sense. And of the 5, housing values continue to improve. And the reason I mention that is I want people to feel comfortable in knowing that there's always going to be changes in the market, but don't always relate to 2008. So one of the things Lisa just mentioned, and one of the things Steve Harney said, and I believe him to be 100% correct, is again, we're facing now a snowstorm. Again, it's an event. So he continued by saying, it's like there's 6 feet of snow on the ground and it's still snowing, but now it's snowing at a much slower pace. And as Lisa was saying, and as we all know, the snow's going to melt. But when it melts, all the buildings are still going to be intact. The financial institutions are well funded and will be in place, and consumer confidence will rebound. So we're not saying, and he's not saying, and I don't believe anyone is saying, that we're going to just flip a switch and everything's going to be absolutely perfect, as if it was prior to the virus. But one thing we truly believe, it appears as if we're going to get back to normal at a much faster pace than from anything we've seen in the past. So a couple of other things just to share with you. Forecasters from Goldman Sachs, JP Morgan, and Morgan Stanley are all saying the same thing. And this is what they're saying, bottom line, that we're in for a wild ride during the second quarter of the year where we are right now, but we need to buckle up, because even though we're in for a wild ride now, we're most likely going to be in for a wild ride going up the third quarter and beyond. So almost every major financial institution agrees that we're going to have what's called a V-type recovery. Strong down, strong up. And Steve Harney gave the analogy as if it's almost like you took a tennis ball and threw it as hard as you could against the ground. It's going to bounce back up again.
Yeah.
So there's a consulting firm, which is a major consulting firm for the real estate industry, John Burns Consulting. And they actually did an analysis on this. And their research team, if I was to quote their research team, it would say, historical analysis shows us that pandemics are typically V-shaped. And John Burns Consulting studied past pandemics, and they're saying it's going to be, again, a V-shaped recovery, and it should not impact housing prices dramatically, frankly, if at all. And according to the Harvard Business Review, they put out a paper in April saying it's worth looking back in history to place the potential impact path of COVID-19. They went on to say that V-shapes monopolize the landscapes, just like prior shocks in the country, including SARS, the 1968 H3N2 Hong Kong flu, and the 1958 H2N2 Asian flu. So in each of those cases, whether it was a major pandemic, there was a V-shaped return in the economy. So feel comfortable that it looks to be true, that we're in a wild ride right now, and we all know it. I mean, the stock market goes up, and then it goes down, then it goes up, then it goes down. March was a terrible month for the market. April was a great month for the market. So again, we got to buckle up and then be prepared for a wild ride up. I got a couple of other slides I'm going to share with you, but before I do that, I want to mention a couple of other things. If we took everything I just shared and we threw it out, what I want you to know is, personally, I talk to realtors every single week across the country. And what I find is, if you look at most markets, at least the markets where realtors are allowed to show homes, because as you guys know, there are certain markets you couldn't show homes for a good month and a half. But in every market where realtors were allowed to show homes, although the market was down, homes were selling. As a matter of fact, in many markets, realtors were getting multiple offers on properties. So the thought is, if multiple offers are coming in on property during the pandemic, imagine what's going to happen once this pandemic or snowstorm is over.
Exactly.
So real estate always has and continues to be a very stable investment, an investment we could live in and we can enjoy. But if you pulled out 2008, it's always been consistent. And even after 2008, and that was a 3-year ride, things came back over a period of time, yet this is not like that.
Yeah.
Now, in addition to all of this, what you want to realize is one of the biggest things affecting our market is, bottom line, people can't work because of regulation. It's not because they don't want to work or because the businesses they were working for just weren't producing enough product.
Yeah.
So I want to share with you another slide, slide number 3, annual home price appreciation. This is an interesting slide, and let me tell you why. I referenced how pricing has gone down dramatically in 2008 with the economic challenges we had. Yet the 4 recessions prior to that, 3 of those 4, the values actually went up. The biggest reason that there were challenges with the market value in 2008, when the market had major problems, the financial markets, is because of the unrealistic appreciation that many were enjoying in the years prior. So if you look at 2000, 2001, 2002, 2003, 2004, and 2005, you've seen pretty much appreciation year after year from 8% to 12.5%. And what you want to realize is, if you look at 2003, pricing went up 8.7%. But then in 2004, pricing went up 12.5% above the 8.7%. And then in 2005, pricing went up 11.4% above that 12.5%.
Yeah.
So there was massive appreciation, which really wasn't realistic. And then we had economic issues, and something had to give, and that caused what we faced in 2008. If you look at today, you'll see 2014, 4.4, 2015, 5.2, 2017, 6.4, 2018, 4.8, 2019, 4.7. Those are great numbers, but they're not crazy numbers. I remember practicing in 2004, 2005, I put a house on the market, and it was like, I better get back into my office because there's going to be 30 offers on the property.
Yeah.
And there'll be 30, 40, 80,000 above list price. It was unrealistic. So today, we don't have that. We have a more stable real estate market, so the chances and opportunity for decline are far less. And that's one of the reasons I wanted to show you that slide. Today, the other thing to look at is interest rates are at all-time lows. And it's strongly suggested that employment numbers will go up again, and things will eventually get back to normal as we enter the 3rd quarter of the year. Remember, and I touched on this briefly a little bit earlier, but remember, the change in the economy this year, March and April, was due to an event, not a financial disaster. Prior to the virus, the United States was experiencing all-time high employment, extremely low unemployment, significantly increased wages for most blue-collar workers, and lower fuel costs for every American, and lower taxes. In regard to just increases in wages, 2 administrations back, in an 8-year period of time, income rose an average of $439 per year over 8 years. The previous administration, over an 8-year period of time, the average blue-collar income was increased by $492. Again, over 8 years. However, over the last 3 years, income's been up on average approximately $1,192 in 3 years under the current administration. So low unemployment, high employment, higher wages Lower fuel prices and lower taxes gives people more money to use based on how they want to use it.
Yeah.
So again, another difference now and the past. And one of the things that Keeping Current Matters brings up is home inventory levels today and in the past. So Lisa will be one of the first to tell you, and so would everyone on the team. Entering the year, the biggest challenge that we all prepared for in the housing industry was inventory. Literally, there weren't enough homes on the market for the number of people that wanted to buy those homes.
Well, and this is
So
a national, sorry to interrupt you, Carl. This is a national statistic. In
yes, it's a
our area,
national statistic.
in our area, in the Bay Area, we were actually much less than this even. We were running at about a 1 month supply of homes at any given moment. So it was even more of a challenge here. Sorry to interrupt you.
Absolutely.
Yeah.
Yeah, but again, with such a tight number of homes in inventory, makes for a stronger real estate market.
Yeah.
So a balanced market, just for everyone to understand, is a 6-month inventory of homes. A balanced market for buyers and home sellers is a 6-month inventory. Above 6 months is typically deemed a buyer's market, and below 6 months is typically deemed a seller's market. So today, we're at a nationally 3.1 month supply of inventory. And if we could show slide number 19, which is monthly inventory of homes. If you look at 2007, there was an 8.2 month supply of inventory. And then that number actually grew through 2008 and 2009. But before the crash, there was an 8.2% inventory level. Today, there's only a 3.1% inventory level.
Yeah.
So clearly, that's an indication that not only will prices not go down, but it's a great time to sell your home. Now, a buyer can say, well, maybe I should wait. No, it's a great time to buy a home too. Because if you buy a home during a seller's market, your opportunity for increased appreciation is even greater. And then if you add to that formula low interest rates, which Darryl will talk about, it's a no-brainer.
Yeah.
Okay. So we literally don't have an oversupply of homes, and we have a lot of people that are looking to be in your market. So our inventory is in a very, very good position to keep the market strong.
Yep. I
want to point out one other thing, and that's the percent of median income needed to purchase a home today excuse me, versus 2006. And if we could open slide number 23, percent of median income needed.
We got you covered, Carl.
Oh, you're ahead of me.
We're good.
Okay.
We got you covered.
Okay, so in 2006, a family would spend approximately a little more than 25% of their weekly or monthly income toward housing. Today, that number has dropped to 14.8%. Okay, so we have more money now that we don't need to spend on housing, which puts the homeowner in a relatively strong position. Yeah. Again, 14.8% of incoming revenue toward housing today compared to 10, 14 years ago, over 25%. That's a big difference. That's huge. And again, that solidifies the strength of the housing market. And then finally, I want to go into one more thing. And this is something that I believe most of you will find very interesting. The one thing we know we have right now is unemployment. February, it was almost unheard of. Today, it's a big number. So with the first round of layoffs, 10 million people lost their jobs in about a 2-week period of time, towards the end of March, beginning of April. This alone shows how things are different today with the housing market compared to the past. First off, I don't know of any other time, at least since I've been in the real estate business, where so many people lost their positions, their jobs in such a short period of time.
Yeah.
However, when this passes, meaning the virus, and it will, restaurants and bars will open, beauty parlors will start to open, construction will start to get more back online, the servers, the bartenders are going to get back to work. The healthcare workers are going to be getting back to work. So you
Hey,
could say, well,
Carl,
what is he talking
sorry
about?
to interrupt you, Carl. I think we have a wonderful slide for this one too. Francesca,
We do.
there we go.
And we can
Yeah.
put that up.
Yep.
And I'm going to explain it in a second. And all of these people from most of these industries are going to eventually get back to work. The one industry that probably will be delayed the most is the accommodation industry, hotels and travel. So if we look at the slide, you'll see 59% is food services and drinking places. Now it's not just bartenders, it covers a lot more. It covers food service companies, all the companies that deliver the food and sell the food, the credit card companies that process those charges, the management companies for some of the larger restaurants. So it covers a lot, but that's 59% of the unemployment based on the April 3rd unemployment report. The toughest industry to come back, and it will, is the accommodation industry, yet that only relates to 4.1% of the unemployment. So if you look at retail stores at 6.6%, temporary help services, 7.1%, childcare services, that's all coming back. And healthcare, say, well, healthcare should be great right now. Well, there's a lot of doctor offices, dentists, and other, even hospitals with scheduled surgeries that were all put on hold. That's all going to come back, and that's going to come back, we believe, pretty rapidly.
Yeah.
So you can see that the biggest concern is the accommodation industry, and again, that represents 4.1% of the total. Yet in saying all of that, I also want to point one more thing based upon history. The unemployment and the home sales numbers generally do not have a direct or negative effect as it relates to housing. And we have a chart for that, unemployment and home sales. So obviously, the lower the unemployment, the better the home sales are. But even when employment is down, as you could see by the yellow line, and the unemployment level goes down, you don't see a big spike up in home sales, nor do you see it the other way when employment goes down. So in 2000, as an example, when the unemployment rate went down, housing went up, but it didn't go through the roof, and vice versa. So we're in a really good position. And the biggest thing is the activity and the inventory within the market. So in closing, what I want to say is this. Based on everything we're seeing, everything we're reading and hearing, and based on the history of other issues our great country has faced in the past, it appears as if we will have that V-shaped turnaround. And frankly, two things. One of which is, I own a lot of property. I'm not panicking. But if I was looking to buy or sell a home in today's market, there's nothing out there that would stop me, virus or not.
Yeah, exactly. Thank you so much, Carl. There's one more economic slide that I think would be awesome to show. Here we go. This was a big one. This one really hit me hard when looking at when we had so many people in the last 2 months come to us with some questions and a little bit of fear. And what about 2008? And is this going to, is the market going to crash? And this was just such an interesting thing to me, because I remember being, like Carl, have worked in the industry through all of those crazy ups and downs and all the different changes. Back in 2008, the average consumer debt in our country of mortgages was over $824 billion. I mean, I remember buyers back then coming to us to buy homes that they clearly couldn't afford. 105% loans. They were buying homes at negative amortization because they felt like, oh yeah, no problem. I'll just sell the house in a few years, even if I can't afford it. It's okay if I buy a home I can't afford. And people were taking their homes and, like you said earlier, Carl, taking vacations, buying expensive cars. They were using their homes as ATM machines, basically. So when the mortgage crisis happened in 2008, people were so unprepared. Today, the total is $232 billion. I mean, such a significant difference between '08 and today is the amount of money that people have been taking out of their homes. So I just wanted to point that out, that our country is so much more equipped to be patient and allow for that V to recovery, where they're not going to panic and sell off and, and cause the crisis that we had in '08. So super awesome. So now what we want to do is, thank you so much, Carl, for sharing. Gosh, we so appreciate your insight. You have such a wonderful history and knowledge and expertise. So we so appreciate your being here with us.
Absolutely.
Yeah, and I know that Carl's going to stay on. We're going to do some Q&A at the end. So of course, any questions you have, either type them in for Carl, or we could wait till the Q&A. So Daryl Nelson is going to share some about loans. One of the things that people have asked me, I have heard probably 100 times in the last 2 months, Daryl, are there loans closing? Oh my gosh, can anyone buy a house with a loan? So tell us about what's going on.
Oh, thank you, Lisa. Yeah, so as Carl mentioned, given the current economic conditions, interest rates, of course, are at or near their all-time lows.
Yeah.
And if you're considering purchasing in this current environment, as always, it's imperative that you speak with your lender of choice and get pre-approved. And it's very important that you know your number. And what I mean by that is, when I speak with clients, maybe for the first time, and I'm qualifying them, I'm surprised at how many people are actually qualified for more home than they may feel comfortable paying. And so it's very important that we start off looking at what you're comfortable with, not what you're qualified for. And that way you can guide if it's worth going a little bit higher. So for example, if somebody's qualified for a home at $800,000, well then, and then we end up finding out they really want to qualify, more comfortable with a $600,000 sales price. Well, you're going to taint the process a little bit, right? There's going to be something about that $800,000 home that you like more than the $600,000 home. And it might be harder to kind of pull the trigger because you really like that more expensive home more. So it's really important that you start lower and go higher. And one of the things that I thought would be kind of useful, given the fact that we live in such a wide range of property values in the Bay Area, just looking at a couple examples for West Contra Costa County. And the first example that we're going to look at here is on a sales price of $500,000. And this example here is more indicative of a first-time home buyer. Now, one of the things that I want to mention in terms of first-time home buyers is that the programs themselves, the vast majority of them are income-based. So if you're above the income limit, you won't qualify for the program itself, but there's still great 5% down programs available and many other options. But in this case, this is more of a first-time buyer program. And so we're looking at a down payment of as little as 3% down. So obviously that's $15,000. And with the mortgage payment on a 30-year fixed mortgage, right? No prepayment penalty, the rate's 3.25%. And that's a mortgage payment of $2,110. Now, when it comes to property taxes, one of the things that a lot of times first-time buyers don't realize is that the county will have you down as the owner of the property right away, but it usually takes them 6 to 12 months to get around to reassessing. So as a result, we kind of guesstimate what that property tax is going to be, keeping in mind, of course, that it does vary from city to city. But the example or the standard that most lenders use is 1.25%, and that's of the sales price, and that's what's reflected here at $520 a month. When it comes to homeowners insurance, the homeowner or prospective homeowner is going to provide me with whoever they want to use for their insurance. Normally, you're going to work with whoever has your car insurance because you want to be able to bundle those coverages and you will receive a discount as a result. The last item is the monthly mortgage insurance cost. Now, what mortgage insurance is that that's basically an insurance policy for the lender. It provides the lender with the level of security, knowing that even though they're only lending at 3% down, the mortgage insurance company will reimburse them if there was a default. So it allows the lender to have a higher level of comfort to be able to lend at such a small down payment. Keep in mind that the mortgage insurance is based on multiple factors like the size of the down payment, the credit score. What's important in this example is that the insurance is $214 a month. However, because this is a first-time home buyer program, this mortgage insurance is actually calculated assuming they were putting a 10% down. So that could be a really big savings for a potential first-time buyer. And so as a result, our total payment is $2,919, as you can see there. And one of the things that's important is having a client, especially if they're a first-time buyer, maybe they haven't talked with an accountant, maybe they do their own taxes. So it's important that maybe they reach out and talk with a family member or a friend, get a referral, maybe talk with an accountant and kind of find out what their tax benefits are, because that could be a huge factor. Actually, I was just talking to somebody this morning looking to buy their first home, and it turned out that their tax benefits was about $500 a month. And that got them thinking, because let's say in this example, they're looking at a $2,900 payment. All of a sudden they think, well, if I can afford the $2,900 payment and that's really a $500 savings for me, well, gosh, show me the more expensive homes. And maybe that's the difference between finding something they truly love and feeling like they're just maybe settling to buy their first house. Yeah. So in our next example, this is obviously a little bit more expensive. Okay, we're looking at a $1.2 million sales price and the 20% down payment. Perhaps this is somebody that currently owns a home, of course, has benefited from property appreciating and has a larger down payment. Interest rates on this program, again, are fantastic. We're looking at an example of 3.375%. Again, 30-year fixed mortgage, no prepayment penalty. That payment's about $4,244. Property taxes, keeping with my last example, estimating at about 1.25%, would be about $1,250 a month. And home insurance, again, maybe a larger home, maybe nicer amenities. Insurance be a little bit higher at $150. Total payment, $5,644.
Well, and what's great, Daryl, is what most consumers, they might not necessarily look at this, is if you're renting a house that's valued at around $1.2 million, given the tax situation, the tax savings, you're looking at a payment that's less generally than what your rent would be. So
without a doubt. Mm-hmm. Yeah, absolutely. And that's why it's so important to, have not only know the number that you're comfortable paying, but when you're able to incorporate your tax benefits, it could really, you could find yourself actually looking for a more expensive home and still feeling very comfortable with the payment. So the two examples here, you guys, is just, just two examples. Now we have the full gamut of programs. These are conventional loans, of course. We do FHA, we do VA. We have all the programs available to basically tailor that loan to a buyer's specific needs.
Yeah, exactly. Well, and Daryl, you've been so great with us for so many years, such creative, saving us from other lenders in the middle of a transaction where the other lender isn't able to get the job done, and you've been able to come in and get creative and help us help our clients better. So we so appreciate that. And one of the most important parts about seeing someone like Daryl is just truly to find out what you're comfortable with, because some other lenders might push you into a loan that you can afford, but we want to know what you're comfortable with. We want to help you. So,
absolutely.
So thank you so much. And I want to make sure that anyone has any questions for Daryl, go ahead and go into the chat or question, and then we'll do some Q&A here shortly. But what we wanted to do is, as a team, we have people come to us every day with questions and concerns and fears about certain things. And so we want to go through and answer some of those. And so TJ is our agent who specializes with buyers, first-time buyers. So he's going to share a little bit about some strategy for first-time buyers. So thanks so much, TJ.
Well, thank you. Hey, everybody. So my name is TJ, and I specialize in helping first-time home buyers. I'm actually working with a good friend of mine right now who's working on buying his first home, and these are some questions that I got from him that I thought would be helpful for me to answer. So the first one that he asked me is, how much do I owe you as a realtor? How much do I have to pay you? And the answer to that is nothing. As a buyer, you don't pay anything. It's all covered by the seller. They pay both sides of the commission, which is awesome. So, we do all the work and you don't have to pay anything. The next question that comes up a lot is, am I able to back out if I change my mind, and what happens to my deposit? which is a great question. So you have a certain amount of time in the contract that states that you're allowed to back out whenever you like. If you find anything wrong with the house or if you change your mind, you're totally protected and you're not going to forfeit your deposit. So a lot of people worry about that, but it's really not something that you have to worry about because you're totally protected. Another thing that a lot of people ask, and some people do and some people don't do it, is do I need to be pre-approved before I start going out and looking at houses? And we would always say, yes, you definitely should get pre-approved. And the reason for that is because some people might go out and look at houses that, are a lot, maybe below what they can even afford, and they don't even know it. So it's just a good way to really know what you can afford and what you can look at, and it's going to save you a lot of time. And the second benefit to being pre-approved before you go out and look is if you get that pre-approval letter and you start looking, once you find that house, you're going to want to be, ready to go, and that enables you to do that because you have to have that letter when you submit your offer. So that's a super important thing, and we always recommend you do that before you start going out and looking at houses. And then lastly, what are the closing costs? So to not get too deep into it, I'll just kind of go through the list. You have, as a buyer, in certain areas it's a little bit different, but you pay for, there's the escrow fee. You pay for your inspections that you do during the whole due diligence process, which some people consider that a closing cost and some people wouldn't, but it is a cost that you would have to pay. There's some wire fees, notary fees, natural hazard disclosures and stuff like that. But yeah, there's, a lot of different costs that go into it, and you're able to negotiate that with the seller too when you submit your offer. So those are some questions that we get a lot, and I hope that helps. If you have any other questions, I'm happy to help at the end with the Q&A.
Yeah, and of course, if anyone is looking to buy a home, whether you're a first-time buyer or not a first-time buyer, TJ's definitely here to help answer questions and anything that you guys need. So one of the things that we get all the time from families as well is for anyone who owns a house that they're wanting to sell, is what type of improvements give you the highest return and what improvements allow you to maximize your price range. And so Diana Carcamo is a specialist on that arena. So Diana's going to share some information. Thank you, Diana.
Hi, thank you, Lisa. So thank you for joining us today. So I wanted to talk to you about how to prepare your home for sale, and then also generally what upgrades will give you the highest rate of return. So this is one of the biggest questions that we get from our sellers all the time. They're trying to decide, what upgrades will give them the highest value on their home. So there are a few things that we generally recommend, and these are the areas that we most see success in. So we'll go through the list here. So the first one being lighting. So you want to make sure your home has good lighting. You want to replace old fixtures with new fixtures. A fresh coat of paint. It goes a long way. It will, it can give your home a different look. Yard work, you want to make sure you have good curb appeal because this is the first thing the buyer is going to be seeing before they step into your home. Flooring, if you have hardwood floors, we recommend refinishing them, replacing old carpet with new carpet. Photography is a big one. You only have a few seconds to capture that buyer online, so you want to make sure you have a good photographer and he's capturing good images of your home, and the buyers are able to see that online. And another big one is staging. So if you're kind of on the fence about that, let me give you a good statistic. So right now, the average buyer is about 30 years old, where the average seller is about 60 years old. So you really want to try to capture, the current buyer right now. So the next thing, right,
people that are 60, sorry to interrupt you, Diana. I was going to say, those that are in their 60s have a beautiful home that they love, but it's different than what the 30-year-old is really looking for. So you want to use that balance of what Diana is suggesting to appeal to the biggest audience, right?
Yes, for sure.
Exactly.
So the next thing, we're going to take a look at a few before and afters. So here we're looking at a kitchen makeover. So I just want to point out with this home, it was actually on the market for about 4 to 5 months with another realtor, and it didn't sell. So we took over the listing. They spent about $8,000 on upgrades in the house. We sold it over asking and just in 2 weeks. So here we had recommended painting and staging. So you can see what a difference just by painting out those cabinets. The room looks totally different. It opens it up. It's airy. It's brighter. We added some modern little decor there and modern furniture. So let's go to the next one. So here, so the same thing, you know, we recommended some painting and staging. We just moved around the layout of the furniture and just opened up that room. So in that photo, you can see a different angle of it. It's brighter. It just looks more open and more welcoming. And then we'll go to the last one here. So on this photo, again, you know, recommending painting and staging here. And you see the difference. You know, it just looks more modern. It looks brighter. So it just really changed the look. Go ahead.
So sorry, Diana, I apologize. Even like you mentioned photography, just the angle of the photograph of that room, it looks like a completely different space, you know, appealing to the 30-year-old and then giving it that awesome look. That's great.
Yeah, and you guys go through every photo before you post anything, if I'm remembering correctly.
Yeah, of course.
Yeah, we do. Yeah. So just from, you know, these photos, you can see what a big difference some minor changes, you know, can make when preparing your home for sale. And another question that we get asked a lot from sellers is, you know, do we have any services that will help with home renovations before going on the market? And yes, we do. We have a concierge service that will help plan home renovations. We take care of the project from beginning to end. You know, we can get quotes out to you within 24 to 48 hours. And the biggest thing is that, you know, we take on the stress, so we relieve the stress from you and the time. And another nice thing is that you don't have to pay until the close of escrow. So by planning ahead, you know, you're making your home turnkey, and then you're allowing for a smoother and faster sale. So if you have questions about the renovation or preparing your home, please let us know, and we're happy to answer those.
Yeah, good job, Diana. And the best thing about it is they can pay at the close of escrow. For those that don't want to come out of pocket, you know, this is the answer. So that's awesome. So, so that's great. So thank you so much, Diana. So another question we get often, of course, with the last couple months to significant change in how we adapt, right? We adapted very quickly to the technology that's available. So Felicia is a technology expert in the process, and she's going to share some of the things that we're using to help our sellers to get more exposure and help buyers too.
Yes, of course. Thank you, Lisa, so much. And I'm so happy to be here, and thank you for joining us. I am Felicia Lopez. I will be going over and answering questions about technology and how we are adapting to the new change for the better. We here on the Doyle team have always been a very tech-savvy team with high interest in the new technologies to better serve our clients. So I'm especially excited to go over a few of our favorite products right now. As I'm sure most of you are aware, because of COVID-19, we have been forced to go virtual overnight. Our favorite virtual products right now are Matterport, the virtual open houses, and our virtual reality glasses. So what is Matterport? Well, essentially Matterport is a dollhouse view of a home that allows the ability to create a 3D virtual environment of a home, both interior and exterior. The Matterport system allows for measurements of 99% accuracy and gives the consumer the ability to walk through a home without physically being present. This gives the ability to actually manipulate as if you were there touring the home in person. This process is extremely efficient. You may be asking, how will this sell my home? Which is a great question. Well, the majority of home buyers start their home search online. Real estate listings with visual content like Matterport and video receive 403% more inquiries compared to those without it. That's huge. So even when this pandemic subsides, these tools will continue to be very valuable in selling your home. So next up, the virtual open houses. This is a personal favorite. I love doing these. A virtual open house is a virtual live stream. We use Zoom and provide this live stream at the home where buyers are able to sign up for the live stream virtual tour. We, the agent, walk through the home with the prospective buyer on a live stream and are able to show them any part of the home and answer questions. This is a great tool as well because it gives us the ability to follow up with buyers and for buyers to be able to get all the information and great visual before making the decision to come see the home in person. At that time, we will schedule a private showing with the buyer if they're interested in seeing the home further. So the virtual reality glasses, this is a tool we use in conjunction with the Matterport and gives the consumers the actual feel of being in the home and helps them understand the layout before actually seeing the home in person. These tools, and I'm sure more will come out, are not only going to help buyers and sellers in the real estate experience, it is our future. I 100% agree with that.
What I love about this, Felicia, is even once this situation that we're now experiencing where buyers have not been able to come physically to homes, once this is over, we're likely to still maintain the use of this, because think of all the time it saves a buyer. They're moving here from San Mateo or wherever across the bay, which is common. We can help them really get comfortable with the house, get familiar with the house, really decide that they love this home, and then we bring them live. It just is such a great way for sellers to get exposure and buyers to get at
I
times.
agree. And so much of our East Bay real estate is fueled by other areas of the South Bay, San Francisco. So many of those buyers come in our area because of our schools, and we're in the suburbs. We have, it's a great area, and 100% them being able to save time and only go see the homes that they're most interested in. And then it helps the sellers too, because then you're having the buyers who they already pre-qualified your home before they came and saw it. So
you're not wasting your time. Exactly. So that's awesome. So thank you so much, Felicia. And we love the technology. We've always had, but it's even gotten more exciting today. What I love about the current circumstances, it's been very hard on a lot of people. This has been tough. We have a lot of clients that have struggled, and yet out of struggle comes, innovation. So it's like we're learning as we go to help people better, and innovation is going to come out of this to make us better, to make us all better. So I love that. So the last but not least is Kim Winters. She has been a real estate agent for over 20 years. And one of the biggest concerns that most people have is, how am I going to survive selling my home and then I get in my next house, either smaller or bigger? How do I do that? So Kim's going to give you some advice about that.
Hello, I'm Kim Winters.
So Kim, you're a little quiet. Sorry. Hey, Kim, you're a little quiet. You need to turn up a little bit.
Is that better?
A little bit more.
Oh, I don't know. I'll have to just talk loud.
There you go.
Okay. Yeah, can you hear me?
Yep.
Yep. Okay. So I'm so excited to be here and just be able to share some information. And what I wanted to talk about is over the last 20 years or so, one of the biggest questions and concerns we get is, how do we smoothly transition from one home to the next, and without being displaced or homeless in the interim? I mean, that's always a bit of a fear and concern. So, and that's a really great question. And what we want you to just know is it can be done smoothly and have it be an easy transition. But the biggest key in that is just having a plan. And so what I wanted to just go over is what that plan looks like, and kind of talk about that, so that to educate you, so it makes sense. So one of the first things we would do is we would sit down and customize a plan to fix up, declutter, stage. Kind of goes hand in hand with what Diana was talking about in terms of getting the house ready and getting the most bang for your buck there on what the things that we can do to maximize the value. And then, of course, determine what is your home worth. The next step would be to connect with a great lender, such as Daryl, and get pre-approved based on the approximate net proceeds from your home. And the next part is the really fun part, which is to get educated on the market. And so we get to go out and look at homes in your price range. And what that means is, it doesn't mean to go out and find a home necessarily to purchase. It means to get educated. So if the lender says, for instance, that you're approved up to, say, 1.2, we're going to get in the car and go take a look at homes in that price range to make sure you're comfortable with the market. At that point, we would put your home on the market and get into contract with a buyer that would agree to a rent back. And what a rent back does is it allows time. And so it basically is buying time, so that once we get your house in contract, that is the time to go look for a home and then potentially rent back, say for 15 days or 30 days, to give us time to find a home and close escrow. And so we then accept that offer with the rent back and go out and find a wonderful home and smoothly transition from one home to the next. Some people ask, well, can't we write a contingent offer and not sell our home first? And that is certainly an option. We can talk about, the pros and cons to that. But ideally, the best situation to maximize your money and get into contract is to get your home sold first. So, but feel free to ask any questions, comments, or reach out to me and we can definitely go over more specific questions.
Don't you think, Kim, too, by doing it this way, they put themselves in the best position as far as both situations. Like, for instance, when you list your home and you're not desperately trying to sell it quickly so that you can buy this house you have as a contingent, you're going to maximize your negotiating power, right? You're powerful. And then as soon as you're sold, you then are powerful on the buying end too. It's like you just have the best of both worlds, you know, and that rent back gives you that freedom of time, you know.
Definitely puts you in a much better position to negotiate on both ends, I think.
Exactly. So thank you so much, everyone, for sharing. And I know we have some questions that have been popping up on our question line. And what we have at the end here is anyone who registered for our webinar, we're going to forward you out the slides and all the information. And if you have questions for anyone after the webinar today, you're so welcome to reach out to us. We're here available. Everyone's email addresses and phone numbers are listed. And we are all honored to answer questions and anything that we can do to help. So thank you so much. And so now let's jump into some questions. We're going to have our wonderful technology wizard, Francesca, jump on. And she's going to read off some questions for us.
Oh, also, can I just mention under question and answer, there's one that says answered, but it really hasn't been. I just said we'll be answering them at the end. So you may want to look at that one as well.
Oh, cool. Thank you. Very good. So we'll look at that. So Francesca, so who has questions? Give the first person's first name and then what the question is.
So Michael is asking, does anyone know what California or the Bay Area inventory percentage is?
Yes. We can actually give you exact statistics. It's a little bit dependent on the area, like where you live. Prior to the shelter in place, like our previous slide said, we had less than 1 month inventory. Our market in 2020, the first 2 months, was one of the hottest markets that I've experienced. I've been in the business 34 years in this area. Tons of demand, very low inventory, and prices that were really rising well. So when we froze in the middle of March, nothing changed with that. And now just this week on Monday was our first day that we actually could start showing homes again. And we've seen just a wonderful demand. Inventory still hasn't spiked. The next month or so might be a little higher, like people that have been waiting to come on the market are likely to start listing. But we don't see a real massive flood of inventory yet. It's still very low. So we're still at a very low percent, about 1 month right now in our East Bay. So a little bit of it depends on the price range and in your exact location, but let us know where you live and we'll help you as well later too.
Okay, so we have a question here. Sorry if I'm mispronouncing it. It's either from San or San. Their question is, for someone who is looking for a second home or a vacation home, would this be a buyer market? And their second question is, how does the supply and demand for homes in an area that is relatively known for tourism, such as Napa or Monterey, would be in the same market position as buying property in a typical residential area?
Yeah, that's a good one. Carl, you want to answer that question?
Sure, I'd be happy to.
Yeah.
Typically, in most seasonal markets, you're going to find a similar scenario as within a year-round market. Even though we're indicating and believe that the accommodation industry is going to take a little bit longer to come back, that's going to be broken up into a lot of different types of industry within that sector. So cruising, as an example, will probably take a little bit longer than some of the other industries in the sector. Hotels will come back sooner, but not to the highest extent. But when you're looking at real estate, we don't see, other than, and I'll give you a specific in a second, we don't see a big difference. People that were renting homes will most likely continue to rent homes. It may go down a little bit only because of the fact that maybe people don't want to travel too much. But overall, I don't think you're going to see a big trade-off with real estate. Now, there are a couple of markets in a few states, Delaware as an example, where they're talking about not allowing use of the beaches throughout the entire summer. And they have a very short window for summer. And that could certainly hurt the rental market. That may lower rental prices. However, most of the people that own those properties are long-term investors. And even though one season may go down in revenue, maybe even no revenue, I don't think it's going to cause those property owners to liquidate at a fire sale. I just don't see that happening. If anything, I see rental values for this year in certain markets like that going down, just the rental amount, but not the property value.
And don't you think, Carl, places like Las Vegas, where tourism is almost their entire revenue, like their economy base, they're going to suffer more than places like the Bay Area or other parts of the country. New York and Vegas are the two that I think of that are probably going to get, they're going to suffer a lot more of a stalling market for a while,
I would agree with that.
Market. Yeah,
Absolutely.
for sure. But one thing that I was thinking with this question is a lot of people that like to travel, and they stay in hotels. They might have a little bit of a resistance of hotels, where we might see a spike in second homes because of that. They might decide, I want to just buy my own place to go vacation and not have to worry about staying at a hotel,
Well, it's interesting you say that, Lisa.
Yeah.
My wife and myself own a home in the mountains, and we never rented it. Today, believe it or not, I got a call from a company that does rentals, just prospecting, asking if we would consider renting that property out month at a time during the summer months.
Yeah.
So that's a very good point.
Interesting. Yeah, that's wonderful. So thank you for the question.
We have another question from Caesar from San Ramon. He says his wife and him are currently considering downsizing since their children are no longer living in the home, and he's asking if it is if this is a good market to lease the entire house or rent some rooms out in their home.
Well, that's a good question. I can answer that one. So you mean keep it as a rental and you rent it out rooms instead of renting out the entire house?
Yeah, he's asking which one would be, if it's a good market to either lease the entire house or to just rent the rooms out.
That's a good question. So in our area, rentals are always in good demand. San Ramon has award-winning schools. So people come from all over, out of our state and inside of the Bay Area, come to our San Ramon looking for a place to lease while they get to know the market a little bit. So rentals are always in high demand in San Ramon. I would say renting out rooms, you might see that less for a little while, given the whole circumstances of people being a little cautious of others with, germ situation and the fear that someone else might be exposed to some places or people that they don't want to be exposed to. So I would say renting out the entire house at this point would be better than renting out rooms. That would be my advice to anyone who's that may change. Yeah.
And another possibility, something to consider, is selling the property, taking the equity from the property, capitalizing on the market, and then doing, whatever investing you want to do with those funds.
Yeah, exactly. Yeah. But that was a good question. That's a really good question.
So there was one question here, I'll just let you know real quick, that I had answered, but I thought, I said we would also answer it live. I just want to point out it's on the Q&A part. So it says, how does home inspection work now? And this is from San Budaman. How does home inspection work now, given an in-person visit is nearly impossible? How does it get done, and how does it affect the loan funding requirement by the mortgage provider? So I had kind of answered it saying that because we are deemed essential, we are able to perform the inspections. It's not, right now at the moment, it has not affected any of the transactions. But I thought that maybe Daryl and Lisa could also make a point on it, because he did ask, does it affect the loan funding requirement by the mortgage provider?
Yeah, I'll let you answer that, Daryl.
Oh, sure. Thank you. Well, we want to make sure we kind of clarify what inspection we're maybe referring to. So if we're referring to maybe like a general home inspection or maybe a termite inspection, well, those are usually reports, depending on how the contract is written, that myself as a lender, I may not actually see those reports, right? So if the contract's written and you're not asking for a termite report or a clearance, that's not something most likely I'm going to see. And trust me, you don't want to give the lender more than what they're asking for, when it gets to underwriting. When it comes to the appraisal part of it, yeah, there was some definite changes in the appraisal process. I won't mention the bank, but one bank that came to mind, it was a colleague of mine, and I was talking to her, and I said, hey, Grace, how are things going? She says, oh, rates are great. And I said, well, how long are you guys taking to close a deal? And she goes, well, a little longer than 30 days. Well, technically, it was a lot longer than 30 days because the shelter in place had just went into effect, and their reaction was, we're going to wait until the shelter in place is lifted. So I kind of had to tell Grace in so many words that she was probably technically out of business for a while. But really what's happened with the appraisal part of it, though, is that, we've adapted. And one of the things that we've done is we've gone away perhaps from interior inspections so that the appraiser is more inclined to do what we call like a drive-by appraisal. So in terms of like arriving at a value and having a level of comfort for the underwriter, we really haven't seen much changes. We just have adapted in terms of the type of appraisal. And nowadays, of course, you know, the borrower, I mean, you know, the appraiser has the ability to, you know, look up the property online, look at the interior photos on the MLS. So we really haven't seen much of a change in that regard. We're still getting appraisals done, and we're still closing loans on time, and it's going very smooth.
Yeah, very good. Thank you so much, Daryl. That was good. Wonderful. So Francesca, other questions?
So Son had another question from earlier. They said, I wonder whether there will be a high number of foreclosures as in 2008. Are there sufficient contingencies planned by government and financial institutions to help people retain their home despite the high unemployment rate? And essentially they're asking, what I mean is, will there be an oversupply of homes for sale like in 2008?
You know, that's a good question. So some of the data we went over that Carl shared indicates that, you know, this is not likely to be like a 2008 for all the reasons that we talked about before. You know, buyers that have bought homes in the last 10 years, you know, and one of the statistics that we didn't share yet is in our country and in our area, our numbers are actually very consistent nationally, is over 50% of the consumers in the Bay Area are 50% equity or higher, meaning they own their homes, you know, 50% of their home is owned in equity. 22% are owned free and clear. So compared to what we were back in 2008, where people were over leveraged and consumers had, you know, $860 billion worth of debt on their homes as compared to now 230. I don't think we're going to see a lot of foreclosures. I mean, that would be my guess. If anyone is in a position where they need to sell because their business has struggled, most people have enough equity where they could go ahead and sell their home without having to, you know, most consumers are not going to foreclose on a home that they have equity in. I guess that would be the best way to answer it.
Right.
They'll sell it. They'll sell it. So we have not seen, and I was like Carl, involved in the bank-owned markets back in, you know, 2008 and then in 1991, where we saw quite a bit of bank-owned. I don't see it coming. What do you think, Carl? What would be your opinion?
I agree totally.
Yeah.
If someone does have a financial issue where they need to liquidate or sell the property, most people have enough. There's two things. Number one, most people now have equity in their property.
Yeah.
And number two, the market is so strong that they'd probably sell their home within 30 days, if not less, at a realistic price, so they won't have to give it away.
Exactly. And our prices in the East Bay, we're seeing stable. That's the best. I had a client ask me yesterday, what's going on? Is it falling? Are we expecting to rise crazy? Is it going to be going up or down? It's like, I don't see us having a crazy market either way. I think we're going to be strong and stable. I think there's healthy demand. There's a lot of buyers that we've all been working with, our whole team, people that were on March 13 were eagerly looking for a home. Everything just went, you know, frozen. And now they're like back in because we just got the ability to now start showing homes again this week. And people are wanting to get out and buy and find a home. So it doesn't feel like the fear has overcome people. You know, we didn't have any houses during the shelter in place that were in escrow prior, or the buyer panicked and backed out. That didn't happen. They just were eager to get closed and eager to get their home and, you know, eager to make a move.
Right, absolutely.
Mm-hmm.
Yeah. So if there's any other questions, anything else, Francesca?
Yeah, so Caesar's asking if anyone knows of any property management companies that we can refer him to.
We do, and we'll give you some recommendations. We have a few property management companies that we work with a great deal in the area, so we can recommend, and we can also help you with that as well. So we'll get back in touch with you about that. You know,
does anyone else have any other questions?
Any questions? Any questions on the live stream? Because we are streaming live on several different portals, which is so exciting about today's technology that we can share and help many people, you know, that need information. We're able to help them, so we're excited about it. And
yeah, very cool. I have a camera going too here, this section, so I can do my live and everything. So it's very cool.
Yeah, so we're so excited that all of you joined us today. We sure hope that the information has been helpful. This information will be available. We will be emailing out all the slides to everyone that attended. And then if anyone that, of course, this stream will also continue to be playing. So anyone who wasn't able to attend, for those of you that are turning in after, just send us an email with your questions and we're happy to help you. So we thank you for joining us. You guys take care, stay well. And it looks like, you know, for a few more weeks at least, we'll be sheltering in place. And you can tell all of us are we're all on from our living rooms and our spaces. You know, happy to be of help. Take care, guys. Thanks for coming.
Thank you.
Thank you.
Thank you.
Bye. Thank you.
Bye.